Good afternoon. This is the Asymmetric Daily Brief for Wednesday, August the 12th, 2026. Today's inflation report was good, and it was good for one specific reason. Energy prices fell, which means the American disinflation story now rests on how much oil is getting out of the Strait of Hormuz. And that is a problem because there are currently 3 published answers to that question, and they do not agree with one another. The United States government says roughly 9 million barrels a day. JPMorgan says closer to 4 million, and satellite tracking counted 84 ships crossing the strait in an entire week. The most important input to American inflation right now is a number nobody can independently verify. That is the brief. Let's walk it. The board, the S&P 500 added 0.3%. The Nasdaq added 0.6, led by artificial intelligence names. The Dow added 0.1, and the Russell 2000 added 0.3. So breadth held up. In rates, the 10-year Treasury yield fell 3 basis points to 4.66%, and the 2-year fell about 3.5 basis points to 4.19, which is the market pricing out some September rate hike risk. Gold sits near $4,415 an ounce, up about 1.1%, and we quote the level and the dollar driver rather than a contested percentage. Bitcoin is near 64,200, up around 1% and essentially unbothered by the print. And in energy, West Texas Intermediate is near $83 while Brent is above 89, having now risen 5 sessions in a row. Equities celebrated the inflation print. Energy is quietly threatening to take it back. Start with the report itself, because the details matter more than the headline. The Consumer Price Index for July rose 0.1% on the month and 3.4% over the year, down from 3.5 in June. Core inflation, which excludes food and energy, rose 0.2 on the month and 2.5% over the year, down from 2.6. Both readings came in essentially where economists expected, so there was no surprise in either direction. Now the composition. Energy prices fell 1.5% on the month, and that was the single largest downward contribution in the report. Shelter, meanwhile, rose only 0.1%, and yet still accounted for roughly 2/3 of the entire monthly increase in the headline index. Put those two facts together and you get the real picture. The non-energy portion of this economy is not disinflating in any meaningful way. Energy is simply covering for it. Which brings us to the first of today's asymmetric reads. Consensus says the Hormuz crisis is winding down. The United States Energy Secretary said this week that the 7-day average for oil leaving the strait is up to almost 9 million barrels a day, and that including pipelines and terminals, which bypass the strait entirely, total regional flows run near 15 million barrels a day. He added that on one recent Sunday, more than 20 million barrels left the region, which would be above the pre-conflict average. Against that, Kpler, which tracks cargoes using satellite imagery and shipping transponders, counted 84 vessel transits through the strait across an entire week. The pre-crisis baseline, according to Lloyd's list intelligence, was about 73 vessels per day, which is north of 500 in a week. And JPMorgan estimates actual flows closer to 4 million barrels a day, less than half the official figure. These are not accusations of dishonesty. They are 3 institutions measuring different things and reporting them with equal confidence. But an economy cannot run on 3 incompatible numbers. So how do you adjudicate that? You stop counting ships and you look at inventories, because inventories cannot be spun. Either the barrels are in the tanks or they are not. And here the data is unusually clear. Global oil inventories are drawing down at a record pace. The Energy Information Administration estimates the global inventory draw in the second quarter of this year at 8.5 million barrels a day, which is the largest quarterly draw ever recorded. And inventories across the developed economies are projected to keep falling until the final quarter of the year, dropping below 2.3 billion barrels by December. That would be the lowest level in agency records going back to 2003. Hold that against the claim that flows have returned to normal or better. If oil were genuinely arriving at pre-conflict rates, the world would not be emptying its storage at the fastest rate ever measured. That is the second asymmetric read, and it is the higher conviction one. Today's disinflation is rented, not earned. Third read, and this one is a genuine correction to the prevailing story. The reflex reaction to this month's Grok 4.6 launch was to treat the word frontier as marketing. but the independent benchmarks do not support that dismissal. Artificial analysis scores the model at a general-purpose evaluation rating of 1,753, which places it behind only Claude Opus 5, with confidence intervals overlapping Claude Fable 5. On the broader intelligence index, it scores 61 against 63 for Claude Opus 5 and 62 for Claude Fable 5, so it is genuinely at the frontier. But the interesting part is not the ranking. It is that this model reuses the same 1.5 trillion parameter base as its predecessor. The gains came from supervised fine-tuning and reinforcement learning, not from adding scale. If post-training can move the frontier, then the capital expenditure per unit of capability assumption underneath a great deal of artificial intelligence infrastructure math is wrong in an important direction. A larger model is reportedly weeks away, which will run that experiment for us. Follow the money, starting with rates. The print did what a good print does. The 2-year fell to 4.19%, the 10-year to 4.66%, and some September rate hike probability came out of the market. Notice the direction of that sentence. The live debate this summer has been about whether the Federal Reserve hikes, not whether it cuts. That framing is itself the regime signal. Headline inflation at 3.4% with core at 2.5% gives the Federal Reserve no particular reason to move and no cover at all to ease. So a hold in September remains the base case. The swing factor is not the labor market, and it is not shelter. It is energy, which means the September decision is quietly hostage to the same Hormuz arithmetic we just walked through, which makes energy the entire macro story rather than one sector among many. Brent crude has now risen 5 sessions in a row and sits above $89, while West Texas Intermediate is near $83. That is the transmission belt into everything else. Falling gasoline prices pulled the July inflation number lower, and the same mechanism runs in reverse if the strait tightens further. This crisis is now in its 6th month. With traffic disrupted since late February, and what movement exists through the strait happens largely under naval-escorted convoy rather than normal commercial shipping. There is a genuine counterargument here, and it deserves stating. Vessel counts undercount ships that switch off their transponders, ship counts are not barrel counts, and bypass pipelines never appear in any strait transit figure at all. All fair. But none of it explains why storage is draining at a record rate. Now the dollar and gold, and this is the most revealing detail of the session. Gold trades near $4,415 an ounce, up about 1.1%, after touching $4,434 on Tuesday, its highest level since the 5th of June. Consider what should have happened. Inflation came in cooler than the prior month. Yields fell, hike risk was priced out. On an ordinary day, that combination is mildly unhelpful for gold. Instead, gold rallied to a 2-month high. That is not an inflation bid, because inflation just declined. That is the market paying up for insurance against a geopolitical tail, supported underneath by persistent official sector demand. China's central bank added roughly 20 tons to reserves in July, its 21st consecutive month of purchases. When the disinflation print is good and gold rallies anyway. Gold is telling you it does not entirely believe the oil number either. On artificial intelligence capital, the build continued to compound. CoreWeave rose about 18% after narrowing its loss per share and meeting revenue expectations. Supermicro rose about 9% after beating on earnings and offering an upbeat forecast for the coming quarter, though it fell somewhat short on revenue. Together, those results drove a broad global bid for artificial intelligence infrastructure names. Structural picture has not changed from yesterday. Capital is still chasing electricity and land rather than chips, and frontier laboratories are still contracting directly for power. What today adds is the wrinkle from the benchmark data. If capability can be improved substantially through post-training rather than raw scale, then the demand for compute remains real, but the assumed cost per unit of capability may be considerably softer than the current spending plans imply. In crypto and policy, Bitcoin held near 64,200 through the inflation print, up around 1%, and essentially unmoved in either direction. The date that actually matters is legislative. The Senate Majority Leader filed cloture on the Clarity Act on the 8th of August, which sets a procedural vote for 2:15 in the afternoon Eastern Time on Tuesday, the 15th of September. Now, cloture is not passage. And this distinction is where most commentary goes wrong. The motion requires 60 votes to limit debate. With 53 Republican seats, that means at least 7 Democrats or independents have to come across. The bill cleared the Senate Banking Committee 15-9 in May, after the House passed its version back in July of 2025. The sticking point has not changed. It is ethics and conflict of interest safeguards and illicit finance provisions. What is genuinely new is simply that there is now a date on the calendar, which forces every senator onto the record. A word on positioning and sentiment, drawn from market and social sentiment monitoring across the session. The commentary split today was unusually clean. The larger share of attention went to the inflation print and to the artificial intelligence earnings, both of which were read constructively. A much smaller share went to the shipping and inventory data, which is where the actual disagreement lies. That is a familiar pattern, and it is worth naming. When a headline number is reassuring and the underlying measurement is contested, attention concentrates on the headline. The most shared commentary of the day was not about oil at all. It was about consumer goods reformulation, artificial intelligence safety disclosures, and model benchmarks. Meanwhile, the single largest quarterly inventory draw ever recorded passed with comparatively little discussion. We would simply observe that the crowd is arguing enthusiastically about the wrong number. The tell of the day is a single figure, 84. That is how many vessels satellite and transponder tracking counted transiting the Strait of Hormuz across one recent week, against a pre-crisis baseline of roughly 73 per day. Set that beside an official claim of about 9 million barrels a day leaving the strait, and JPMorgan's estimate of roughly 4 million, and you have the real information of the session. The most consequential input to American inflation is currently unauditable. Forbes published a piece this morning under the observation that a dearth of reliable data now plagues crude oil market assessments generally. That is the tell. It is not a number. It is the absence of one. Sectors in play, energy first. The bull case is a record inventory draw, a choke point operating under escort, and 5 consecutive up sessions. The bear case is an administration actively messaging that flows are normal, and United States crude inventories, which just posted their largest weekly build since February. That is the widest gap between official narrative and physical data in any sector right now. Artificial intelligence infrastructure second. The bull case is that core weave and supermicro both delivered and backlogs keep growing. The bear case is the quiet suggestion from the benchmark data that capability may not scale linearly with spending. Demand is real. The per-unit assumption is the soft spot. And third, consumer staples. W.K. Kellogg confirmed on the 6th of August that it will remove artificial colors and the preservative BHT from its entire cereal portfolio by the end of 2026, a full year ahead of its previous commitment, moving to colorings derived from fruit and vegetable juices with capital investment behind the switch. The reformulation is real, and it is early. Whether it turns out to be a cost or a competitive moat will show up in gross margin, not in the press release. On the radar, tomorrow brings the Producer Price Index for July, which is the pipeline check on today's report and will show whether energy pass-through is genuinely fading. Weekly inventory reports are the falsifier for today's main read. Continued draws confirm it. Sustained builds refute it. Transit counts out of the strait remain the physical truth-teller against the official flow claim. The Clarity Act cloture vote is the 15th of September. The Federal Reserve meets later that month, with a hold as the base case and energy as the swing factor, and a larger frontier model is reportedly due within weeks, which tests whether scale still buys capability. For the scorecard, 3 new dated and falsifiable calls go into the ledger today. First, that official Hormuz throughput claims will not be corroborated by independent transit data over the next 60 days, and that global draws continue through the third quarter. That is falsified if developed economy inventories build for 2 consecutive months or transit counts reach 50 or more vessels per day. Second, that energy's contribution to headline inflation turns positive in at least one of the next 2 reports. Third, that the next larger model does not deliver a proportionate gain on the intelligence index. All 3 are dated today, and all 3 can be checked. And the close, every institution in today's story is behaving rationally. The Energy Department is citing a 7-day average it genuinely has. Kpler is counting hulls it genuinely sees. JPMorgan is modeling a figure somewhere in between. Nobody here is necessarily wrong on their own terms. They are measuring different things and publishing them with equal confidence. But policy cannot be set on 3 incompatible numbers. And in September, it will have to be set on one of them. Gold, rising on a day inflation fell, has quietly indicated which way it leans. So the question worth sitting with is simply which number the Federal Reserve is actually using. Watch the inventory reports, because storage does not hold press conferences. This is research and education only. It is not financial advice. I'm Earl. The Asymmetric Signal, one contrarian read a day. Subscribe.